Welcome to the weekly update, where I'll go over the action in the market for the week of August 26th through the 30th, and then we'll see how things look for the week of September 3rd through the 6th. The market will be closed on Monday in observance of Labor Day. I hope everybody has a really nice Labor Day weekend, maybe a barbecue, going to the beach, what have you. But let's go back and we'll go through and see how things look after this week. But first, please know that I do daily videos, and that's the real foundation of the analysis that I do. I do make those public right when the market closes. Now, I also have a program where you can get access to those as soon as they're ready. In fact, as I record this, the daily video is already posted, but it won't be made public until Tuesday, right when the market closes. So please feel free to check that out and see if it will be helpful to you. I do put a PDF of the slides that you see right here, as well as the charts, in the description below this video. Sometimes you can download that and it might be helpful. Every day I update pivot points on the YouTube community tab. There are pivot points that last for the whole month. We'll be switching over to some new ones for the month of September. And then there are video or pivot points that I update every day that only apply to that particular day. I do have a private Facebook group. Now, if you're not necessarily interested in being a member of the program that I have, but you still want to have more interaction with me, you're welcome to join. Not a real active group, not a lot of members, but you're welcome to do that if you belong to Facebook. I do really watch YouTube and Rumble comments. I still have to go through every day and delete a lot of these self-proclaimed social media expert comments. They don't even watch the video, but they tell me how great the video is. So I just go through and I delete those, because if they actually watch the video, they would know that I supply an email address, but I don't ever get any emails. Isn't that interesting? I post not only on YouTube, but on Rumble. If you can't find me on one platform, look for me on the other. Sometimes things go bad or go down for a while, and I might have trouble uploading to one platform or the other. I do have the SPX Investing Program. It started in June. It's been growing. If you want to learn more about it, there's a link to take you to the website. There's also a link that'll take you to an overview video. There's also additional videos that talk about the program. Here's an email address if you have any questions and you want to contact me about that. And then one benefit, as I mentioned, is that members have access to the daily video right when it's available, and the weekly video, which I also delay making public. You get access to that right away. And here's the daily video. That's the foundation of all the analysis that I do. Then over here is the weekly video, which is just one of many weekly videos that I prepare. They all tie into the daily video. Another YouTube channel that might be helpful to you is Chris Schiavocco at Schiavocco Capital. He does a video every week. He's a money manager. He takes a longer term look. He also looks outside of different markets. He focuses a lot on the S&P like I do, but he also looks internationally. He looks at other markets within the US with a bigger picture look than I tend to look at, because I focus mainly on the SPY long term. There's another channel called The Kindle Report, put out by Bob Kindle. It's a little more sporadic where he posts his videos. Sometimes he does it every day, sometimes once a week. He does have a newsletter that you can subscribe to, but out of all the channels that I've checked out, these have tended to be the most down to earth and actually realistic. Okay, let's go back and talk about the week session. We were up 0.24%, not a real gangbuster. We would have been down on the week, but there was a surge right at the end of the trading session on Friday that kicked us up a little bit for the week. We were below average with volume. Now, the only day that saw above average volume was Friday, but that was the last day of August. It was also the last day of the week, and it was, again, the last day of the month. So there's probably a little bit of window dressing going on there as we get ready to go into September. We are positive, and we're positive in the short term, but there's some vulnerabilities that I go through in the daily videos. But we're looking overbought in the short and intermediate term. We're looking positive longer term as well. So we want to at least go with what the charts are telling us. Now, we're possibly entering September, which is a weaker month historically. Doesn't mean we'll go down, but quite often, September has been a difficult month for stocks. So be aware of that and actually get more defensive. In my program, I teach about hedging. There's no reason anybody should ever lose money in the stock market. And I teach about that. That's kind of my rule number one. I mean, everybody thinks, why do you get into the stock market? To make money? No. The first rule should be don't lose money. Then rule number two is, okay, now that we've positioned ourselves so that we won't lose any money, how can we make money? And I have found over the decades of doing this, that's a much more conservative and longer term. That's a really good approach to take. We did get a reading on inflation in Friday's session with the core PCE. That was taken as friendly. And pretty much all the economic reports coming out have been friendly to the market. Now, this week, we're going to get a lot of employment data. On Friday is going to be the employment situation report. That's what the market's really focused on. Is it going to come in line with expectations? Is it going to be stronger than expected or weaker than expected? And that could have a real impact on the market. Because if employment starts to look weaker, the market's going to turn negative again with their view on the economy, thinking that we might be going into a recession. If we come in with what's expected or even stronger than expected, that shows that the economy's hanging in there. But then they pretty much have counted on interest rates being cut at the September 18th meeting when the Fed gets together. If that report is really strong, that could really freak out the market too. So the ideal situation would be to come in as expected, but still showing good growth, not an awful lot of weakness. We want to keep an eye on all the geopolitical things going on. They have not really had any impact on the market, but that can always change. Okay, then the condition of our trend, we're still weakening. And we're actually not trending now in the short and intermediate term on the daily charts. We're still positive. The green line's on top, but we're going into a trendless environment. And if you look at a daily chart that I'll show here in a minute, we've been range bound, especially the last week to week and a half or so. We haven't really been going anywhere. Even with Friday's upward move, we just went to the top end of the range that we've been in, but we're still positive. The green line is above the red line, even though the green line is going down. It's still above the red line. Okay, so here's some bullet points. The markets will be closed on Monday for Labor Day. So it's just Tuesday through Friday in the upcoming week. Stocks ended up having a mixed week. Some indexes were up, some were down. In Friday's session, the Dow set a new all-time high. NVIDIA came out with their earnings. They were much anticipated, and they came out with a great report, but they didn't overwhelm the market with their great outlook into the future. And so the market took the stock down in the after hours, and it ended up being down. It's bounced back a bit now, but it wasn't the big euphoric party time that everybody thought was going to happen. The economic reports that came out were taken as market friendly, not too hot, not too cold, the Goldilocks approach here. And interest rates are up, but they're still under 4%. We closed at 3.91% with the 10-year yield, where a week ago we were at 3.81%. And the dollar, after really coming under pressure, it bounced back up. Now, it's still in a downtrend, but it is going back up after it had gone down pretty severely. And volume was below average every day of the week this past week, except on Friday. We actually went above average then. Okay, so the Dow was up 0.9%, not much, but still enough to set an all-time high. The NASDAQ was down 0.9%, so that's where we see the mixed here. The S&P was up 0.2%, actually 0.24%, and small caps ended up being unchanged on the week. I've been showing this chart for quite a while now. We just want to keep this in mind. We're still in this light blue area with inflation coming down. This is CPI, comparing it to what happened from 1966 to 1982. And we were coming down here in 74, 75, 76, our bicentennial year for the US. And then all of a sudden, things started to change. We had a presidential election that year. Some new policy was implemented, some geopolitical things happened, and inflation just took off and really went up after that. We don't know what's going to happen now. We can speculate. We can try to come up with scenarios to suggest that maybe inflation is going to go up. There's a lot of people, you watch other videos, and they're going to say inflation, we're just going to go through the roof. There's other people, you watch their videos or listen to what they have to say, and they think inflation is going to stay under control. Nobody knows. We just have to follow the information as it unfolds and then adapt things accordingly. This is the RenMac research showing that we're under that 4.02% at 3.91. That means that it's helping earnings for companies. When we get above 4.02, that's when the interest rate starts biting into corporate profits. Okay, this will be updated a week from now. This is the number of unemployed for 27 weeks or over. That's more than 6 months. And it did go up last time. So we're going to be watching this when the employment report comes out on Friday to see if there's any drastic change. And I'll be talking about that in next week's weekly video. We are still looking good when we look out into the future with earnings for the S&P, whether it's Morgan Stanley or the consensus, they're going up. And that, as I always say, justifies prices going up as well. Then I'm going to show this in intermarket analysis video too, because we deal with commodities looking at daily charts, where here we look at weekly charts. But from the 60s up through about the mid 70s into about 1980, we saw commodities really going up, and that was an inflationary period. Well, then from about 2005 until after the COVID crash, commodities have really been going down. Now, this is just a guess, but they're starting to go back up, and commodities have been in an uptrend longer term, and we'll look at some charts. But if they continue to go up, that could be inflationary as well. This is sugar, cocoa, pork bellies, and oil, and precious metals, and all those things. When you take them all together, they're all called commodities, and it's expected that they're going to continue to go up. Now, we don't know. They might turn and go down. There were other times here through the 80s and 90s when everybody said, okay, commodities have bottomed out and they're going to go back up, only to come back down. So we'll just keep an eye on this. That's why I do the weekly videos and the intermarket analysis videos, just to keep an eye on these things, because they're bigger picture type of things that we look at. Then looking at heavy truck sales, continuing to go up. There's strong sales right now. This tends to bode well for the economy. Then looking at the largest inflow into treasuries, we're seeing a lot of money as bond yields are coming down. That means interest rates are going lower. That means the bond prices are going up because they go opposite of each other. And as folks, they just got hammered back in 2022. It was one of the worst bond years ever, going back to the 1700s or something. Well, now they're looking a little bit more attractive, and so a lot of people are putting their money into bonds, especially treasuries, because they're considered to be very safe. They're put out by the U.S. government and backed by the full faith and credit of the U.S. government. Of course, if you don't have much faith or credit in the U.S. government, they could be considered risky, but there's never been a default on these. Okay, then China exports. Now, the only reason I bring that up is you can see here, if you take out the U.S., their exports are going up. But if you include the US, the blue line here, it's also going up as well. We get a lot of products from China. It says made in China right on there. And then looking at the core PCE inflation, where we look at the blue line, that's the core PCE. That was the big thing that the market focused on Friday. It's also what the Fed really watches. We have the red line, which are services, and then the light blue line, which are goods, and they're all coming down. When we look at this on a 6-month rate of change basis here, based on an annual rate, it's 6 month, the percent change over a 6-month period of time, which, yeah, okay, but we usually look at this on a monthly basis, and then we look at it on a yearly basis. Is it really that big of a deal to do on a 6-month basis? Again, you can take the data and display it different ways and come up with pretty much any conclusion you're looking at. But the takeaway from this is we are seeing these prices and inflation actually going down. Okay, then real US GDP. Real just means they take inflation into account. The takeaway from this is that we're above the zero line here. So we're looking at positive GDP, at least for right now. New orders and inventories. We're going to get the ISM on Tuesday. That is a big report coming out, and they're expecting it to go up. Now, with that report, when we're at 50 or below, that shows contraction in the economy. When we're at 50 or above, that means expansion in the economy. If we can come in at 52, Now they're thinking by October, but if this can continue to go up, that would mean that there's more growth in the economy, specifically in the manufacturing area. Longest streak of inflows into REITs. This is real estate investment trusts. As interest rates are coming down, real estate is becoming more attractive, and we're seeing a lot of money flowing into that part of the market. No FactSet earnings. Apparently they're on vacation this week, so there was no blog post there. So looking at the intraday chart, going back to Monday here, where we ended up having a down day and we gapped higher, but then ended up closing lower. Then on Tuesday, we started to go up, but then faded near the end of the day. Wednesday was quite negative. This is after, well, actually, it was after the close on Wednesday when NVIDIA came out with their earnings. But we saw quite a bit of weakness here, but we saw some late day buying coming back in. We're well below average with volume here. So it's not hard for a hedge fund or a mutual fund, not necessarily the smart money, but some of the big money out there. They can come in and do some buying or selling and really drive prices in one direction or the other. Then on Thursday, we went up higher and it looked like, okay, but we got back up to these previous levels, the high end of the range that we've been in. And then we started coming back down and we closed pretty much at the low. Then on Friday, we gapped higher and it looked like, oh boy, here we go. We actually went a little bit negative, but then right at the end of the day, we really saw a lot of buying coming into the market. So that's pretty much what saved the week, was this last little surge. Each one of these bars is 10 minutes. And if we hadn't seen that move up at the end of the day, we would have been negative for the week. All right, so looking at the 5 trading days for the past week, all of the indexes except for the NASDAQ were up. Going back to the beginning of the year, all of the indexes are positive with the NASDAQ, S&P, and now NASDAQ 100. This is the big mega caps. These are the growth stocks. It's actually gone into third place. It's still doing very well for the year. But usually when I do these videos, we show the NASDAQ 100 first, the NASDAQ in second, and the S&P in third. Now we're seeing the NASDAQ first, the S&P second, and the NASDAQ 100 in third place. Another takeaway from this is that all of the indexes ended up being positive. And then looking at the different sectors, I do this 2 different ways. We had an up week, so we saw financials, industrials, and materials doing about the best. The 3 areas that were down were communication, discretionary, and tech. These are the areas we want to do well. This is growth versus value. This is buy low, sell high. These are the areas that really drive the indexes up. And they were down on the week, so that's a little bit of a concern. Going back and looking at the scooter score, where we have the utilities and financials looking really strong. They're in the 90s, followed by real estate. That for much of 2024 and well before that, 2022, 2023, the real estate sector was at the bottom of the list. Now it's looking a lot stronger from a technical analysis perspective. And we have discretionary and tech getting pretty low scores right now. That's a bit of a concern to the market. All right, then looking at the sectors for the week, financials, and that's encouraging because it was the financials that fell apart back in late 2007 into 2008, and that drove us into the great financial crisis. Well, the fact that financials are doing well, at least at this point, now this could always change, but for right now, that's rather encouraging. And then industrials, materials, and healthcare were up on the week. Healthcare tends to be more defensive, and these are more growth areas. These tend to do better with interest rates going down. Then all the other sectors ended up being down on the week. Then going back to the beginning of the year, we have financials now looking the best, followed by communication, which are down this week, and then utilities, which are just barely positive now. And all of the other sectors, the way that I measure them here, they are negative on the year. All right, then we look at a relative rotation graph. Up in the right-hand corner, these are the strongest areas. And look at how real estate, now this goes back over the last year. This had been way down here in the minus area, looking red. Look at how it's really moving up here. Okay, so that's a stronger area for the time being. Utilities, which could potentially be another defensive area as well, they're showing some strength right now. And we look at tech, it's red and declining and actually looking pretty negative right now. So is the market getting set up for September to be weak? We could make a case for that, but until we see that in our charts, we don't want to assume anything. We want to wait for confirmation. And if you want to keep really up to date with what's going on, watch the daily videos that I do. I know they're long, I know people are busy, but if you really want to understand what's going on, those videos should really help you quite a bit. Then here is just kind of a spreadsheet looking thing with real estate and utilities looking the best. Then we have other areas that are also strong, but not as strong. And then the red areas here, like energy, materials, tech, and communication, especially tech and communication, these are the growth areas, and they're not performing all that well currently. Then this is going back with the different indexes to the beginning of the year. Utilities are still looking the strongest, where we have the S&P 100, the NASDAQ 100, and the S&P 500. They're showing some weakness now. We're seeing small caps looking a little bit better, the Dow Jones Composite and the Transportation Index. Isn't that interesting? And even the mid caps are showing some strength. So we're seeing a bit of rotation going on here. The real stronger areas are showing some weakness, and some of the weaker areas are now showing some strength. Now, that could also be taken as positive. It means that there's not just 7 stocks driving the market higher or lower. There's more stocks actually participating in the move, and they tend to be going up and showing strength here. All right, and then here's a spreadsheet kind of thing with the Dow Jones Utilities looking the best. We have the transports, mid caps, the Dow Jones Composite, and the small caps looking better. But with the small caps, and I'll show you that chart, we're not really breaking out. We just didn't have a real bad week. Where you have the bigger large cap type indexes like the S&P 100, NASDAQ 100, and S&P 500, they're actually starting to underperform and showing some weakness. Sentiment, just to give you an idea here, this is predictit.org. I took a screenshot of this a few hours before I started recording this video, where it still has Harris at 54 cents, predicting that if the election was right now, she would win, and Trump coming in at 48. This changes many times every day. The reason I put this in the sentiment section is because we're so divided in the country right now. There's people that just hate Donald Trump and think he's Hitler and all that stuff. And there's other people that say if Harris becomes president, it's the end of America as we know it. And so the country is really divided along that. And there's a lot of sentiment, a lot of feeling going back and forth about this election. Then looking at fear and greed, we're actually looking positive here. We were able to get up out of the neutral area and back up into the positive area. I call it positive, they call it greed here. And here's a chart where we were going down at the end of July and beginning of August. We got below 25. That's when we start to look at using this as a contrarian indicator. And that's about the time we hit a bottom. And we started coming up and we went above 50 only to drop back down. Now we're back above 50 again. When we're going up, until we get up to 75, we roll with this, we go with it. So if this tends to go up, we're seeing sentiment as positive as well. And that's currently what is happening. The active asset managers did show a little bit of improvement, but not necessarily extreme right now. Here's another chart showing how the latest reading for the active asset managers came in at 81.34. And the Ulcer Index still showing that there's not an awful lot of fear. It's up off the lows. And I stopped showing the daily chart in the daily videos because we were really high with the Ulcer Index, and now we've really dropped down. This was developed for mutual funds and is really only based on closing prices, and it's an attempt at using sentiment to try to figure out, are we seeing a lot of fear, or is there not a lot of fear in the market? Here's the VIX. This is probably what most people look at, where we are coming down. We're still getting some kind of high readings now compared to where we had been, but we dropped down a little bit this past week since we had an up week, both with the line chart and the bar chart. And this is the seasonal tendencies of the VIX. This goes from 1990 to 2023. And it's kind of interesting here. That big down move that we saw at the beginning of August, we should have been going down with the VIX. We spiked all the way up above 65, came back down. But keep in mind, the VIX is often weak as we get into September and into October, and possibly near the end of October as we lead up to the election. If this is going up, that typically means stocks are going down. Now, we may not follow that pattern this year, but we might just follow it as well, or at least get close to it. Then we look at the VIX and a 3-month average of the VIX and take a ratio. This is declining, and that tends to be positive. And we're also going back down with our 253 period moving average of the equity put call ratio. That's also longer term positive. And why do I have this again? Here's the active asset managers. Well, in case you didn't get it last time, you got it now. This is looking at the spread between risky and not as risky bonds. For a while, I was showing this in every daily video because we were getting a little bit concerned here. The takeaway is this next chart where we look at the middle area and it's inverted from the chart that we just looked at, where we're starting to come back up here. That means that fear is decreasing in the spread between the risky and not as risky bonds. And that is more positive for the market. If this really starts to go down, that means fear is increasing, and that could be more negative for the market. And we look at the Ridex bear bull ratio. When this really spikes up like it did at the beginning of August, that means folks are getting into the bearish mutual funds. And now we're getting quite a low reading because they're in the bullish funds as the market's been going back up. And another sentiment gauge, I look at cash versus the tech sector. When this is going down, that means the tech sector is outperforming, and that's what we're seeing right now. The latest reading from the American Association of Individual Investors, they are looking more positive, but we're not necessarily extreme positive right now. Then here's looking at GDP. We did get another reading this past week. It was the second reading where we got the initial reading a month ago, where we're coming in at about 2%. Again, the takeaway from that is that we're positive, where the forecasts are anywhere from about 2.5% to the upside and just a little bit under 1% to the downside. And here's looking forward here. Again, the takeaway is that they're looking at positive GDP because we look at a lot of different charts to see if we're going to go into a recession. And periodically, I do a video that I put on the website that talks about these are the charts that suggest we're going to go into a recession, and these are the charts that are not. This would be on the side that we're not, because one of the definitions of a recession is you have two quarters of negative GDP back to back. And nobody's really predicting that at this point, but that can always change. And here's another look. Takeaway from this is that we're seeing positive GDP across the board for now. And then the Chicago Financial Conditions Index, as long as we're below the black line, things are okay according to this chart. Now, this hasn't been updated in a month. This is a big deal. The perma bears are salivating over this. A month ago, this came in above the red line. It's hard to see that, but it came in at 0.53. The red line is at 0.5. We're going to get this updated this coming Friday. If it comes in stronger than that, this may indicate that we're going to go into a recession. However, you can follow the Psalm person, I think it's a lady, on Twitter or X, and even she's made comments saying, well, maybe this time it's not right because we're just coming out of the COVID lockdowns and all the stimulus and all the crazy things that happened back then. Maybe we'll be able to avoid a recession even if we go above this 0.5 level with the indicator. And this is the creator of it. And even she's not really sure if it's legitimate or not. So the perma bears are all excited about this, thinking that we're going to fall apart, and we might. But let's just look at the data as it comes out and go from there. Then another one that will be updated is the smooth U.S. recession probabilities. We're still below the black line in the latest chart that we have. Then this is updated quarterly. The Brave Butters Kelly leading index, it has been coming down, but it's above the black line. If this turns and starts to go back up, that would be a concern. All right, inflation, it did readjust this past week with the core PCE coming out. And then the week before that, we had CPI coming out here, but inflation's not really changing all that much. Then what's going to happen at the Fed meeting? This is as of the close on Friday. The market thinks there's a 70% chance that they're going to cut rates 25 basis points. That would be 0.25% cut. There's 30% saying that it's going to be 50 basis points. And that's what they talk about on all the financial channels and everything. Oh, I think it should be 50. I think it should be 1.5%. Whatever. Okay. Right now, the market thinks, yes, there's a 100% chance that there will be a rate cut because a week ago, Chair Powell came out and pretty much said that at Jackson Hole. So it's just not that they're going to cut rates. It's how much are they going to cut rates? And this is how that has changed. Not an awful lot over the last, because this dark blue is right now than a day ago, a week ago. It was higher a month ago, but it hasn't really changed over that much over the last week. Then we also just want to keep an eye on the November 7th meeting. And they're also predicting rate cuts at that meeting, but this will change many times. And it's pretty much across the board, whether there's going to be a rate cut at all the way down to maybe a full percentage point from where we're at right now. Okay, looking at the Fed balance sheet here, and only government charts can do this. We're going down over here, but we're going up with the latest reading. Figure that one out. And then we look at the year over year change, where this is pretty much flat and it's actually declining a little bit with the latest reading. And then this is something we keep an eye on, not really causing any concern right now. These are the overnight reverse repurchase agreements. When this really goes down or up severely, that's when we really take notice of this. It's pretty much been going sideways lately. All right, looking at the advanced decline line on the weekly chart, we're looking pretty solid here based on price and volume. We're not quite breaking out on the daily chart, but we're looking a little bit healthier here on the weekly chart when we compare it with volume. That's been a concern as we've been going up since we hit that decline in early August, is that price has been going up, but volume has been going down as we've been going up. And that's a classic negative divergence. The fact that this is showing an improvement is encouraging. And looking at the new highs versus the new lows, we're seeing a lot of new highs being generated. So that's making our 4-week and our 10-week average go up. And that's another internal measure that looks pretty solid. We're going up and we're actually starting to look extreme with our 19-week advanced decline ratio. So this is getting a little toppy here. We're still going up in positive with the 39-week advanced decline ratio. And then we look at a weekly chart of the accumulation distribution. We were showing a little bit of weakness on the daily chart. In fact, this is the daily chart. Okay, I meant to bring up the weekly chart here. But this is still above the moving average, and this measures how far away. It tries to measure that, how far away we are above or below the moving average, and this is still looking rather healthy for the time being. Then here's our trend. Now we're positive because the green line's going up, but the ADX is below its moving average and declining. That means that we could be seeing a weakening trend, but for right now, we're still trending. Even on the daily charts, we're not. We're also showing a weakening trend there, but we're positive on the daily charts and here on the weekly chart as well. The Erin indicator is coming down, but is still above zero. That's positive. The mass index, we're still wondering because the mass index tries to pick out a reversal that will happen. We're not seeing a signal generated here, but we did get one, my gosh, a week and a half ago at least on the daily chart, but the market's just been chopping sideways ever since then. Then here's a daily chart where this is the chopping sideways part. And we do have this pivot point, which could be acting as overhead resistance. The S&P has not set a new all-time high yet. That was set back in mid-July, and we would have to get above this pivot point and close above that to set a new high for there. But you can see in Friday's session, we were above average with volume, but all the other days have been below average with volume. All right, but when we look at the Keller market model, we're positive across all the different indexes and all the different time frames. We're switching to negative with the short term based on the price of bonds. We're negative across the board on all time frames with commodities and the dollar, even though the dollar bounced up a bit this past week. And I'm not sure how dependent this is. This is the decision point scorecard. They just updated this a few days ago and they backdated it to the beginning of August. So it's like, oh, somebody better update this. Well, okay, fine. We're still looking good here. When we look at the trend channel going back to 2009, and we're above this R2 level, and we close near the high for the week, but we're not setting a new all-time high here. But this is still looking pretty good longer term. And when we look at the 50-period simple moving average and compare it with price, they're both going up. Then we do a crossover moving average system. We're above the blue moving average, which is 13 weeks. It's above the 50-week moving average, which is in red. So the S&P is still in a solid uptrend, even though it hasn't set a new all-time high, at least yet. And we're coming down, but still looking rather positive here with the McClellan oscillator. And we're continuing to go up and possibly getting extreme with the summation index. We're also advancing based on volume, but you can see how price has been going up a lot faster than volume. That's a little bit of a concern as volume has been lagging behind. And we're coming down a little bit here with the Swenlin trading oscillator, but we're still above zero based on price, and we're actually declining a little bit further based on volume. But taken together, they're still above zero, so this is positive. And the bullish percent index, this has been encouraging, both on the daily chart and here on the weekly chart. Even when we were seeing some weakness earlier on this past week, the bullish percent index was hanging in there pretty strong. And that just means the rest of the stocks in the S&P are holding up. This measures the point and figure buy signals or sell signals inside of the S&P. And when this is going up, that's more positive. It's not moving average based. It's not an oscillator. It's not momentum. This uses a whole different approach for measuring, are we going up or down based on point and figure charts? And this is really improving here. And then we look at the momentum. We're trying to turn back up with the price momentum oscillator here. We did go up based on price. We went up, but went up less based on volume. And here's some studies that are attached to the PMO. We're coming down, but just coming off of being extreme with the PMOs that are rising. We're just about coming up to the extreme reading with the buy signals, and we're also almost getting extreme with the PMOs that are above zero. All right, we're not extreme right now with the Bollinger Bands. The way I use them here is the percent B. That's, do we close above or below the upper or lower Bollinger Band? We have not done that. We can take this as positive since we're above the midpoint, and that's when we're above down here with the percent B indicator. Taking money flow, a smart money indicator, is looking better and also looking positive for right now on the daily chart. We were getting a little bit concerned. There might have been some weakness coming in, but it seemed to take care of that this past week on the daily chart. And here's the shorter term momentum is going back up. We're trying to turn up with the other short term momentum. The MACD is trying to improve. The PMO is trying to turn back up. The PPO is trying to turn up as well, but we're still declining with our long-term trend, the TRIX and the KST. So we're seeing a bit of a mixed picture here where we're positive across the board, but showing a little bit of weakness. In fact, the slope oscillator is extreme positive on the daily chart. And here's the force index above zero and looking positive. Chaikin oscillator, another smart money indicator, above zero and going up. I've been really focused on this on the daily charts because even when we were going up, this chart started to go down. That was causing a bit of a concern, but it did turn up slightly in Friday's session. And we're starting to cross above the midpoint here with the money flow. So that's actually turning negative now. The rate of change, we had a slight up week, so we're above the midpoint here. We're still looking good if we go back 50 weeks, looking positive here. And we're above the midpoint and going up with the Stochh RSI. We're also still below the moving average here with the special K, a long-term oscillator. It's still positive on the daily chart, continues to be negative here on the weekly chart. And we're above 50 and going up with the ultimate oscillator. So we're seeing a little bit of contradiction between this oscillator and some of our others. And the vortex continues to be positive, even though we tick down. The green line is still above the red line. The copy curve is pretty much flat right now, where we're positive but rolling over on the daily chart. The Williams percent R continues to be extreme positive. It's also extreme positive on the daily chart. And the RSI is above 50 and going up. We're still looking pretty solid there on the daily charts as well. And here is, we're well above this 10-week moving average. And we closed at the high for the week, but we have not set a new all-time closing high for the S&P. Okay. Looking pretty good here with the Heikin Ashi when we measure the trend. We're negative because it's red, but we're going up now with the Kegi chart. The Renko chart has open blocks, that's positive. And the 3-line break has open candles, that's also positive. So a little bit of contradiction here. And the ease of movement is still above zero and positive, even though it declines slightly. And looking at our longer term momentum here, with the long term, we're going up. We're continuing to go up, a little bit flat here in the intermediate term, where we're actually starting to decline slightly in the short term. But this is short term based on a weekly chart. All right, then on August 19th, we did enter a new 50-day cycle. I don't put a lot of importance into this. If you draw enough lines on a chart, you can say, oh, this is happening, that's happening. Well, the only way you really know if this worked or not is by looking in hindsight to know, okay, that worked. That's not good enough. We need to know what's happening right now so we can develop foresight as to what we think will happen. We did have enough of an upward move here on the weekly point and figure chart to generate a new X, but not enough to go back to previous high reading here. But this is quite positive for the time being. We're continuing to be positive with the Elder's Impulse system here for the S&P on the weekly chart. And for the second week now, we are positive with the parabolic SAR. We continue to be positive on the daily chart. Then looking at the S&P, close to that all-time high, the mid caps are coming back up, but have not broken out and set a high here. We're seeing some improvement with the small caps, but still pretty much in the range that they've been in for 2024. And then looking at 2020 to 2024, September tends to be weak on a historical basis. Whether you look at it over a long period of time or even over the last few years, be careful. Make sure you implement hedging. And if you don't know what that means, get in the program that I have, send me an email. Let's set up a time to talk, and I'll try to explain that to you. It's not very complicated. It's not a hidden secret, and there's no conspiracy to keep this information from you. It's just most people don't know that this is even an option available to them. All right, looking at the Dow, we are in a solid uptrend, setting a new all-time high. The NASDAQ is falling a little bit behind, but we were able to get back above this moving average. The NASDAQ 100 also underperforming lately, but still at its 13-week moving average. Here's a weekly chart where it was actually down on the week, even though we've been bouncing up since we had that downward move in late July into August. The mid caps not really breaking out yet, but still positive. The small caps also not breaking out, but still positive. The Wilshire, this is a daily chart, looking pretty good here, but not setting an all-time high above its 50-day moving average. And the 50 is above the 200-day moving average. The big software companies still not really busting out to the upside, but still positive nonetheless. The NYSE setting a new all-time high here, up over 1% this past week. All stocks also setting a new all-time high. The FANG index having trouble with its 13-week moving average. Not falling apart, but not really showing leadership the way it had been before. ARC just kind of floating around, not really going much of anywhere. It was down over 3% on the week. The banks and the financial sector are looking pretty solid here. You can see the bar chart of the weekly bars here. We're above 50 and going up with the RSI, and we're turning back positive with the momentum. And then we're seeing money actually going into banks now, which is more of a confidence type thing. And we look at just a weekly chart of the Dow and the transports. That's traditional Dow theory, setting a new high with the Dow, just going sideways with the transports. Even though they had a pretty good week, they've got a lot of catching up to do. And the utilities have also been really strong as of late. Then looking at commodities, the CRB index, and over here is just a breakdown of the different parts that I alluded to a while ago. We're still in a downtrend here, but it did end up declining. We're coming back up to the 50-week moving average here. Oil, we're keeping an eye on this mainly for geopolitical reasons. If things really escalate in the Middle East, that may send oil up. Well, right now, oil's actually going down. And then gold coming off of setting new all-time highs here, but still in an uptrend. Silver not setting all-time highs, but also in an uptrend. Copper starting to go back up after it was showing some weakness when they thought, oh my gosh, the economy's falling apart. Well, now that the economy doesn't appear to be falling apart, copper's starting to go back up. And then we look at the dollar in a downtrend, both on the daily chart and here on the weekly chart, even though we did bounce up this week. And then looking at the total bond prices here, the total bond ETF, this is quite positive for the time being. We look at a monthly chart of a stock to bond ratio, still showing that stocks are outperforming, even though they pulled back recently. Here's a daily chart of the yields where we had been really coming down. We started to go back up later in this past week. Here's a weekly chart looking internationally where we have US, UK rates the highest, followed by German rates, and even Japanese rates have ticked up slightly. And then here's an intermarket analysis chart. Going back to the beginning of 2024, we have gold in the lead. It's performing the best year to date, followed by stocks, and then oil, and then the dollar. And bonds had gone positive, and now they're starting to drift back and go negative based on price. That's the long-term bond ETF. And we look at a ratio between the NASDAQ 100 and the S&P. The NASDAQ's been underperforming. They're both doing well on the year, but the S&P's actually been holding up better lately. The S&P 100 is underperforming the S&P 500, even though longer term, the S&P 100 has been outperforming. And growth to value, still in an uptrend here with growth outperforming value, but pulling back lately as we're concerned that maybe the market is becoming more defensive. And that's usually what happens before it gets ready for a decline. But we don't know if that's going to happen. We just want to watch and see how things develop. And then we look at a ratio between gold and the S&P, not really showing gold outperforming. You'd never know that by listening to all the gold people, but stocks have actually held up quite well in the meantime. And after we spiked up when it looked like the economy was falling apart, now we're coming back down when we look at a bond to stock ratio. And we're coming back down a little bit as the dollar went up and gold came down, but still gold has been outperforming the dollar. And we look at low volatility stocks, which continue to underperform the S&P itself. And these are more defensive. So the fact that these continue to underperform, that's positive. But the fact that this has been going back up, that's a little bit of a concern to us. We'll look at energy to tech, showing how energy continues to underperform tech, and discretionary continues to underperform staples. We actually saw a recent death cross earlier in 2024. We want this to go up to be more positive. This includes Amazon and Tesla and things in discretionary, where staples are toilet paper and toothpaste, more defensive things that people have to have no matter what's going on in the economy. And then we look at another ratio, the small caps to tech. And this is a weekly chart where the small caps were starting to outperform, started to pull back. And they were actually up 1.5% with this ratio this past week. Then we look at some long-term charts. Now, we didn't get a ZWAC NYSE breadth thrust this past week. This was erroneously posted, according to my chart, on Twitter and Isabel Net. I think that was them. Somebody was, a couple of different places I saw, oh, we have a new ZWAG NYC breadth thrust, which tends to be very positive for the market. We have to go all the way down and drop below 0.4 for that to happen. And then within 10 days, we have to shoot up and go above the 0.615 area. Well, we went above 0.615, but we never went down below 0.4. Now, this is still positive in and of itself. Even though this isn't an official signal, according to this chart, it still means that there's really good momentum in the market. We have been pulling back, though, lately. All right, and then this is a longer-term chart as well, which is still looking more positive. And this is the ZWAG NYC breadth thrust, going all the way back to 1945 and then how things performed. And when you go out a year, it has a perfect track record going forward. All right, the Zohorchak method is still on a full-on buy signal. That hasn't changed for quite a while now. And a weekly chart of the S&P shows that we're above this trend line going back to the 1987 crash. Here's a further blow up of that same chart. We're well above this trend line. The NASDAQ 100 is back above this trend line going back to 2009. That's looking good there. Then we look at the 50-period exponential moving averages of new highs minus the new lows. They're going back up. That's positive for the S&P. And then we look at the NYSE new highs and new lows. And this is also a 50-period moving average, and this is going up. So the S&P is looking good, and the broader market as measured by the NYSE is also looking more positive. Cumulative, new highs, new lows for the NASDAQ. Still pretty much chopping sideways. Down below, this is just a daily score. And then we look at a ratio between the Qs, the NASDAQ 100, and the IWM, which are small caps, still hanging around this really high level that we've been seeing. Not a big change there. We look at another ratio between the NASDAQ 100 and the Dow. This has actually gone down just a little bit, but still giving us a very high reading as the Dow's been setting a new all-time high. Then semiconductors to the Dow, also falling a little bit below this blue line here. We're just keeping an eye on this. If this really starts to deteriorate with more velocity, that's when we'll be more concerned. We also want to keep an eye on this. We're starting to come down here, but we want to know the context. Why are we going down with the 3-month yield? Is it because the economy is falling apart? Not based on evidence that we're seeing right now. Not like it was back in 2007 into 2008. But if this really screams down and economic weakness starts to come in, that's what led us into the great financial crisis. And you can find a lot of people who say, yeah, this is going to happen. It's going to be even worse this time, man. Well, we just follow the charts and see what happens here. Seasonality, September. Well, I should have moved this over. September tends to be a little choppy. It's later in September where we tend to be more negative with stocks. And here is September showing that it's just not performing well. So going back to 1950. And when you look globally, September, August is usually negative, but September is also negative on a global basis compared with everything. And then they didn't update this chart, at least quick enough for me to use, where now we're coming into September during an election year. It tends to be even negative. Be aware that October during an election year, going from 1950 up to 2023, this also tends to be negative as well. We don't turn positive until after the election. Then looking here at September and October, going back to 1928, this also tends to be more negative for this time of year. And then the first half of September tends to do a little bit better than the second half. The second half of September, according to this, going back to 1950, is the worst performing time of the year. All right, then looking at the election pattern, we don't really know what to go with here because when you take all election years, things tend to be more positive. But now we have more of an open field. They've changed the Democratic candidate, and we don't know if the Republican candidate's going to go to jail or not, or there was an assassination attempt. We don't know if something, God forbid, something like that happens. But when there's an open field, when we get into September, this tends to be more negative during an election year. All right. And then I'm not going to go through this. This is just historical, going all the way back over 100 years, and what happened with interest rates and what CPI was doing in different historical events that have happened during this period of time. And this just shows that over a period of time, even though inflation may come in and just suck the life out of the market, after that gets done, the market tends to do quite well. So thank you. I hope you have a really nice weekend, and I will talk to you in the next video.